see. Okay. Well, welcome and good morning, everybody. We are going to go ahead and start our Business 101 interview with our small business experts. This is a short discussion that the Economic Alliance will be hosting to discuss important topics that impact small businesses. This will be a short 5 to 10 question interview that we hope will answer some of your most important need-to-know questions on different topics. We will allow for time for questions at the end and encourage you to reach out to the Economic Alliance and/or our industry experts to find out more about any topic you're interested in learning more about. Today, we will be learning about small business lending, and we are so excited to have Steven Phan, business lender from Craft 3, who will be sharing his wisdom and experience working with small businesses in the Pacific Northwest. Welcome, Steven. Can you share a little bit about your background?
Yeah, thank you, Ronnie, so much. Wisdom is it's a big word. My background and experience is in small business banking and commercial lending. I spent the better part of a decade at JP Morgan Chase and Wells Fargo before that. And then in 2021, I began my stint here at Craft 3, and we're a nonprofit lender, a community development financial institution. So we support folks who can't get traditional bank financing. So I take my experience from the bank, supporting small businesses with all of the products and services a bank does, as well as lending. And then I mesh that into the community development side, and that's where Craft 3 comes into play.
Well, great. It sounds like you have the background and knowledge to help many of our local businesses who are looking to access small business lending. Let's go ahead and get started with our interview today. Now to the first question. When would a business contact Craft 3?
Well, Craft 3, we're a lender. We do loans for small businesses, but we also provide resources like technical assistance, resources on how to start a business, or not directly advise, but resources to find those additional resources. So we are kind of a hub for information, I like to say. Most folks reach out to us when their bank or credit union are unable to do a loan for various reasons. That could be because of time in business. That could be because of their credit or collateral requirements that are necessary from bank lenders. But most folks are coming to us first for a loan. From there, when we get to know them and understand where they're at, we may refer them back out to other resources to support with business planning or projections, or something that will help them become more loan ready. Because a big part of what we do is making sure we do loans that are hopefully successful for us and for the client.
Okay. Can you tell us what are some lending options for startup businesses, and what are the key differences between like a business line of credit, a bridge loan, and maybe commercial real estate loans?
Yeah.
Because some small businesses are looking at purchasing a building that
Yeah.
they need or equipment.
Absolutely. So startup lending is tough. It's a tough field. Most banks don't do it. If you don't have 2 years of business tax returns, a lender is going to consider you a startup. So that's often an initial barrier to lending in general, where you may have access for a credit card, which is a revolving line, but that's pretty much it. When you need startup capital, and you're looking for lending, CDFIs, community development financial institutions, again, are one of those middlemen, kind of step between financial facilities at a bank versus not having any credit facilities. So what startups need to often have is, for CDFIs to do some sort of loan, is going to be projections and a business plan. We often look for experiences as well. But you have to have a lot in place prior to asking for money when you're a startup, because you have to show at a bank, I'm no longer at a bank, but at a bank, they look at, historical ability to service the debt. We want to understand that, and we at Craft 3 want to be able to see what the projections look like, but also understand how you think you're going to be able to achieve those numbers to support the loan, to support the business, to support yourself as an owner. Um, we only offer term debt, which means you borrow X amount of money and you pay it back over a specific amount of time with the same amount of payments monthly over the course of that term. Business lines of credits are revolving lines, which often have a specific amount that you can borrow and then pay back over time, and then the line of availability grows and shrinks based on how much you've borrowed. Those are really specific to the type of businesses that you are running. So like contractors may have projects that they're doing and need money up front and then get paid later. Manufacturing oftentimes uses lines of credits to buy materials to make the product to then sell and then later on get paid. So being able to revolve that debt, we unfortunately don't offer that. Bridge loans are when you may have received a grant from a foundation or a federal or a state grant, but they are reimbursable. So that means you have to spend the money before you get the money back. In order to get that capital, oftentimes we're able to support the initial capital, then just get paid back with that grant funding. Real estate is a tough one if you're a startup, mainly because it's a long time. Typically, the loans are a lot longer, typically larger as well. But we also know that real estate's one of the number one ways to support and grow generational wealth. So depending on, how much money the borrower has saved down, what the purpose of the building is for, what the impact of that business is on the community, like we may be able to take on more risk and figure out a way to do it. Whereas a bank will require you to have at least 2 years in business, be able to service the debt over time. They'll be measuring the risk on that piece of real estate. We look at collateral. Lenders look at collateral as, what can we take if this loan defaults in worst case scenarios. But I think that sets apart with good lenders and just lenders in general is that we also want to lend to people that will likely not default. So we look deeper into these clients, whereas banks are looking at numbers, and there's a little bit of character analysis. But for us, when there's no history, when there's no ability to service the debt historically, we have to really get to know the business owner, the community, and the impacts of it in order to make a decision on risk.
Well, and I know that you touched on it briefly about the documentation that's required. So if somebody is looking, and I know that all of this information will be available on your website.
Yeah.
But can you share with us a little bit more about the documentation that Craft 3 would require in order to even apply for a loan or qualify for a loan with you?
Yeah, absolutely. So we start with whether or not the business is a startup business or an established business. We lend to folks who just can't get traditional financing for whatever reason. And as a startup, there's going to be more documentation required. This also changes based on the type of loan that the borrower is asking for. So for a startup, typically we're going to ask for a business plan, 2 years of projections. We're eventually going to want to understand the personal financials of the borrower. What a lot of folks don't realize is when you're borrowing, your personal credit is also a part of the decision-making process, even though it's a business. A personal guarantee is required for us for most of our loans. So a personal financial statement, which tells us your personal liabilities and your assets. Oftentimes, if they don't have a lot, then it's just for us to understand that there isn't very much, and then we can evaluate from there. A resume, what your history is. Are you a 30-year mechanic and then you're deciding to open a restaurant? Like, how does that align? What's the purpose of that? Or you flip that the other way. It's like you've worked at a mechanic shop for 28 years, and now you want to buy that shop. Like that's, we can utilize your experience to see how it would relate into the new business based on your resumes. And then the other thing for us that we like to think about is impacts. We layer our risk with impact lenses. So we want to understand, is this business going to be supporting the community with new jobs? Are you buying a business to retain jobs? Are you creating childcare? Are you supporting early childhood education? There's so many different things that we can look at where while it may be risky on one end, if there's a lot of impact on the other, we may be willing to look at a way to be creative to get something done. So today, that was a left turn, but business plan, projections, resume, personal financial statements. We have templates for a lot of those. And there are resources that can support you with those pieces when you're a startup. If you're not a startup, then we look at historical tax returns, financial statements, like a profit and loss or a balance sheet. Depending on the type of business, we may ask for your accounts receivables or your debt schedules, just to get an understanding of the business cycles and what you're doing and where your debts are. Returns are, great. We typically ask for a few years if you have them. If not, then we kind of look and see what the problem is or where you are at in your business and your growth, and then try to meet you where you're at.
So with that, I have a kind of a follow-up comment to that. I know a lot of times we've talked to businesses and, there's always been like this, conversation of writing things off, showing very little profit, because again, that goes back to the more profit you make, the more taxes you have to pay.
Yes.
So a lot of businesses, over the years do whatever they can to eliminate, I'm trying to say this in a politically correct.
Lower their tax liabilities.
Yes, exactly. Yes. And
Yeah.
so it shows a very little profit margin. So, what would you tell a business when they're when that eventually you're going to need to take out a loan either for equipment or to purchase property, and as a lender looking at tax returns that show either no profit or maybe a minimal amount, how do you deal with businesses that come in and are requesting funding from you?
Yeah, that's a real double-edged sword in business and commercial lending is, you want to limit your tax liabilities as a business, but you also want to be able to afford to borrow money. So our official statement is to talk to your tax advisor, whether that's your CPA or somebody that you want to touch base with about how to best navigate that, because oftentimes that also rolls over to personal tax and liabilities. So for us, it's hard to lend if you show that you don't make a profit year over year. For any lender, it is. It's a part of doing business is paying the taxes and showing that you're earning money to be able to borrow more money. I will say if the funds at the end of the last year were spent to purchase assets and not just and we can see value in what you're spending your money on, that may support it. But realistically, if you're showing losses year over year or barely breaking even, for a bank or a lender to understand that this is for tax liabilities and we're actually making money, we have to go what we see off the black and white, off the paperwork, off the tax returns. So it gets difficult. It puts us in a hard position where we understand, but we also have to make responsible loans, and giving somebody money that doesn't make money is not responsible to us or the folks that fund us, or even to the borrower, really.
Right. Well, and we find that too. I mean, we get a lot of, as the Small Business Development Center, and we do technical assistance to small businesses. We see people who want to sell their business, and so it also comes back to the value that your business actually has. When you want to get to that point of selling it, you want this amount of money, but if you can't show that your business is valued at that by the money that it's making, so there's that, at the beginning when you're starting and you're trying to break even and move forward with your business and make a profit, but then also on the other end, when you're trying to sell your business, you also want to show that it's a successful business and you're making a profit.
Yeah. And I think
as a
having
lender aren't going to lend something
Yeah, absolutely. And I think having a group of advisors of various types, like the SBDC, is very beneficial because if you're building to exit, if you're building a business to sell, whether it's to retire or to start a new venture, there are different strategies involved with that and different ways of funding to do that. So recognizing the goals of the borrower, I think is number one for whoever they're working with and their team.
Thank you. And I know you touched on this as well, but um, for startups, is there a minimal amount of time that they have to have been in business, or you're just reviewing their business plans, those types of things? And what types of limits are we talking about if they're a brand new business that has no, history, and, again, we're working together, and you're learning about the business, they're learning about you. What type of loans could they access?
Yeah. So I would say it really depends. We go case by case, and that's a part of the reason we're a little different than a bank. We're not just looking at the numbers. We're not just doing loans to make money. We're doing loans to make an impact. So the things that we look at first are impacts. What type of business is this? For instance, Craft 3 doesn't do investment real estate. If somebody owns a bunch of real estate and they want to borrow more money to make more money, that's not really where our dollars are going. But now, if you have a woman person of color who's trying to buy a daycare center, right? That there's a lot of impact there with a woman-owned business, minority-owned business, daycare slots, and that's an example of loans that we've done historically that can support the community, support the borrower, and we'll take on a little bit more risk. Um, and it may be a true startup because she has worked in daycares and early childhood ed for the last 20 years and have saved up a little bit of money to move towards it. We may take on more risk to be able to support that impact. When we're talking about what's available and what you're able to get. Craft 3 has kind of a high minimum limit of $50,000 for our loans, but that doesn't mean you can't call us because if you know our name and you know what we do, we can also refer you to other CDFIs that we work with, not in direct partnership, but that we know can do these types of smaller loans. And if you need 15,000, 20,000, we want to make sure that we right size loans for the borrowers. Um, it can be a larger loan, but then, we look into down payment. What's the equity the borrower is putting into it? If you need to borrow $200,000, first, how are you going to pay it back? Over 5 or 7 years, whatever that term is, that month-to-month payment's fairly high. So we want to understand the business. What type of business is it? Are you generating solar? Are you selling widgets? Are you is it a retail clothing store? How many t-shirts are you going to have to sell? We look at all that granularly, similar to the SBDC, when you're trying to figure out what's appropriate for a size of a loan. Um, so it's hard to say specifically what's available, but we have term debt that starts at $50,000 and goes up to 5 million. When we are evaluating the borrower, there's no minimum time. We have supported folks that are pre-revenue, but it also depends on what available collateral there is, how much is being borrowed, how much they're putting into the project. And again, I'll reiterate the impact of this business. So impact is one of our key reasons of doing what we do. So we often look back at what is this going to do for the community, the people around it. Is it supporting? Are our dollars doing good, essentially?
And when you talk about collateral, what are some examples of collateral that I know some CDFIs and non-traditional lending institutions can use some non-traditional collateral, as well. So, can you give us some examples of what that would look like?
Most often it starts with business assets. So if you're a restaurant, we're looking at the equipment, we're looking at the tables, the booths, and we assign a value to that. Collateral, just for folks, if you're unfamiliar, collateral just means what can be sold or taken to sell to try to write the loan if it goes into default. So collateral on a car loan would be the car, it would get repossessed and then sold to support the loan, whatever the balance is. When you borrow on a house, the house is collateral. But when we're talking about businesses, oftentimes the banks and traditional lenders will require a specific amount of collateral. So a specific amount of stuff that they have access to be able to take in the case of default, in the case that you're no longer able to pay the loan. For us, it's going to depend on the amount of the loan again. And I can explain this in detail, like case by case as it comes up. But really, we're looking for real estate's number one. Like that's the easiest type of thing. We're going to take business assets, but we're also depending on, I feel like a broken record, the impact, we may be willing to be under collateralized. But typically speaking, we're looking at real estate, homes. If that's not available, we may be able to look at other things, but I think the thought for Craft 3 is, with our 30 years in supporting folks in the community, if we're under collateralized or if we take somebody's car's title, I don't think that supports them wanting to do better. They're going to want to succeed no matter what. So we want to limit those barriers. So it really depends. And the key piece, and oftentimes what we look at is real estate. And there are different levels of collateral that we can take on real estate, such as fixture filings versus a deed of trust. And we do that differently depending on the size and the borrower and what we're looking at as well. That can also help affect the rate. So,
And I know that I'm asking continue to ask more follow-up questions,
please.
but there's always questions about Okanagan County. A large part of our county is the Caldwell Indian Reservation. So we work with a lot of tribal members. And do you look at the tribal members who live on trust property and looking at collateral differently there, or how?
Yeah.
How do you?
Absolutely. So it's not the same, right?
Yes.
Tribal lands are not the same as non-tribal lands. So when we're looking at working with tribal entities, for instance, we have an Indian country strategist. We try to lend and understand best we can. We'll be able to take on more risk and have a better understanding because when we talk about land and real estate and we talk about ownership, and then you layer on the native community, that becomes traumatic, a direct barrier of entry that is based and rooted in systemic racism. And those are all things that we're trying to combat. So when we look at that, it really depends. And where we're willing, a loan to an Indian country person, a native person or a rural area, like there's a lot of impact there for us, and we're willing to take on more risk and have a deeper conversation to understand. So that's a really good question. But the general part of the answer is, yeah, real estate's great. But what happens when folks come and take all your land, and then tell you that this is now not yours? So it's I'm trying to make light of a really serious conversation, but it's things that we understand and work with regularly, and we would love to be able to expand upon and support folks who are in those situations.
Thank you.
Yeah.
So I know with Craft 3, being a CDFI and being a non-traditional lender, you're not a traditional bank like
Yes.
the ones that we walk out the door and we see in our communities. So part of it is, you're taking more risk. You're talking to people who might not be bankable at some of our local banks. And so there's going to be higher interest rates and higher risk. So can you tell me, if somebody gets a loan with Craft 3 and approved and, everything's going good, is there any payments or penalties if a business wants to pay a loan off early or refinance it when they feel that they're bankable with their normal bank that they could go to?
Yeah, no, absolutely. That's a great question. So, our rates are going to be higher off the bat than banks. A key reason to that is our cost of funds is higher because we're going out to look for money to be able to lend. Whereas a bank, they hang out and then you and I bring our direct deposits directly to them, right? Then they lend that money out. So for us at Craft 3, the cost of funds are higher. We're taking on more risk. And it's a different model than a bank because we're not making as much money off these loans in the same manner because the cost of funds are higher. So for us, when we are looking to support folks, prepayment penalties are a big thing in many places because the lender is trying to either make money off the interest, and if they can't make money off the interest, it's going to be fees. So for Craft 3, most loans under $250,000 do not have prepayment penalties. You can pay forward on your principal just like any other loan. If you pay it off early, no, we're actually really happy about that. And then refinancing is something that we look to work with people's banks at early. So after a year or two, your lender, if there's a relationship with your banker, will start talking to them about, hey, where are you at with your financials? Do we have all the things we need to move towards a refinance? When we refinance with the bank, there's a couple of benefits. Number one is that the borrower gets an effectively lower rate over time for the money that they borrow. The bank likes it because they get a revenue producing loan and their customer back in their book of business. And then Craft 3 loves it because when the bank pays us back for that loan, we're able to then redeploy more funds out to other small businesses that are either new or unable to access capital. It becomes a revolving cycle. So for us to also charge on top of that, depending on the type of loan, of course, if there's owner occupied real estate, there's going to be different fees and third party costs, and then there's often a prepayment penalty too, just because of the type of loan and the work that goes into it. But for the majority of folks, the small business term debt under $250,000, there's typically not a prepayment penalty. And if there needs to be, we will explain it prior. It's not hidden. It's not put all the way in small font in the promissory note. We're going to talk about that up front to the borrower with how much the loan will cost you, in different scenarios.
Thank you.
Mhm.
Can you give us some examples of successful small business loans that you have done in rural communities like ours? I really think that these stories help our small businesses understand that they can apply and get funded, as many get discouraged when dealing with traditional banking, going in, I'm a new business, and I apply for a loan and they tell us that I don't qualify or I have to be in business for 3 years or, and it's important for us to share some successes and some
Yeah.
stories of how small entrepreneurs have been able to access like programs through Craft 3,
Yeah.
and how they've transitioned and been successful.
Yeah. I think that's a great question and a great item to share and highlight. There are successes. One of Craft Three's regional strategies is rural and tribal communities. So being able to highlight those successes when our offices are also reflected in that supports, us and folks understanding who we are and what we can do. A couple of examples that we've had in the last, I'd say, 2 years. So 2023 and on, we supported in Okanagan County a small cherry farm with a purchase of an adjacent lot. So they had land come up, so they were able to expand their acreage an additional 3 acres, and utilize some of that funding for additional working capital and support on the farm. So that was a $60,000 loan. We were able to support an indigenous native quick service restaurant in Spokane. And to expand to 2 locations and add some working capital. That's restaurants are hard to fund. They are high risk, they are volatile. But with this, it's a woman and native owned food quick service restaurant. So it aligned with what we were doing, what we want to do, and who we want to support. So that helped a lot. In Ellensburg, we had a child care facility. So we helped, that was a new construction, that was a $2 million loan.
Wow.
And so we're talking 60,000, $2 million. We run the scope of it, right? But that $2 million loan for construction supported an additional 112 childcare slots in the area where they're also working with, it's called the Child's Connection Care Program, which supports low to moderate income families. So we're supporting the families with childcare slots, and they're also low moderate income. So these working families are able to support themselves as well. Outside of Washington, a really good example was a business acquisition for a 75-year-old construction supply company in Southern Oregon. Now, this was I don't know if super rural is a thing, but it was a rural deal. But the company, if it was not purchased, would have lost 5 living wage jobs in the area. But with us being able to support them with the acquisition, we retained 5 living wage jobs, but it also created 2 additional. And in that area, in rural communities, jobs are great, but the multiplier of living wage jobs in rural areas is a huge impact when no other bank would do the loan because the person who was buying it while they had worked there for, I think it was like 18 years, they didn't have any ownership experience and didn't have enough money down. So those things add up where we're able to support these small communities with jobs, childcare, food and restaurants, or agriculture as well.
And I guess follow up on just the comment that you made about down payments. I mean, I know that that is also a big hurdle that a lot of small rural, startups and existing businesses are looking at. In a lot of banks, right off the top, it's like 20, you have to have at least 20% down. Is that Craft Three's model as well? Or do you take that in looking at the issues and all, this situation by
Yeah.
situation?
Yeah, so I'll say we don't have a requirement, like a minimum requirement, but we do require down payment. A part of lending and a part of business ownership is risk.
Mhm.
And when we are doing a loan, if we're doing 97% of the loan, I feel like we're taking all the risk. The business owner who's running the business also needs to share in that risk, and it's going to depend on how much that loan is. If they're asking for 50,000 and they have five, that's 10%. That's great. If they're asking for 70 and they have five, it's not quite 10, but it is enough. It might be enough. And it really depends on what the business is again and what the loan is for. Um, we don't have a minimum, but we do want to understand that there's some skin in the game from the borrower, from the business owner, because the risk needs to be shared in order for a borrower and a lender to have a good relationship. Now, we are taking on the bulk of the risk and there is interest being paid, and that's kind of the transaction there. But ultimately, we want to see borrowers succeed. And if they're not taking on any risk, there's a less likelihood of success, I would say. We want them to succeed, but we want to succeed together.
Right. I know we get a lot of people calling and inquiring about grants,
Mhm.
and at really, and I've been here since 2007, and there really hasn't ever been a time where there has been just grants for businesses to start their business.
Yeah,
Uh, and really back, it hasn't been until 2020 where grants actually came into play in this world, and that was in response to COVID. And
yeah,
so we have always, our comment has been just like what you're saying is, businesses, you have to have buy-in, you have to show ownership, you have to, take that risk. And part of that risk is not paying for all of it, but at least having that skin in the game that
yeah,
shows that you're committed and that you're really willing to maybe sacrifice going on a trip, and instead of
yeah,
going on that trip you're taking that money and you're investing back into your business to get it up and going. uh,
yeah. And we also recommend folks look savings important. Being able to save substantial to you, substantial to the business, right?
right.
Because if you're saving, somebody who's making a lot more money can save a lot more than somebody who's not, but it may not mean as much, right? So when somebody is saving, we can see their ability to think long term. We can see their ability to plan and execute. And those things matter in character lending. Those things matter when we are trying to determine, is this going to be a good bet for the organization? We have to we have to measure risk. We have to understand the numbers, but the people matter just as much for us. So listening, understanding, asking questions, and seeing where they've come from. There are also resources like IDAs, individual development accounts, that people can sign up for and be a part of with other nonprofits, where the state and the feds will match savings.
Yeah.
And it's required. I think the minimum is 6 months, and depending on the program, can match anywhere from 3 or 5 to 1. So it allows people to at least get a head start. And it's not a grant; it takes some work, But being able to see folks that go through those processes also show that there's a long-term commitment to what they're doing, and it's not a what sounds cool right now, let's do this. But this is really my passion. This is what I want to do. This is why. Those are the things that can set somebody apart for an approval on an application. And I don't know if this is worth, or this is, if we're going to be able to take this risk, is that difference in how much work they've done themselves.
Well, and we're getting ready to start. We partnered with the Center for Inclusive Entrepreneurship, and they have a Start Simple class and curriculum that we are now rolling out here in Okanagan County. And where we really start, like the first day, is about personal finance. It is understanding your own personal budget. And, what are your assets and what are your debts? And, looking at where where you're currently are at there, because again, your personal finances do play in to, if you want to go and apply for a loan, or if you want to get access capital, even in the non-traditional sense. Or applying for a credit card,
Absolutely.
some of those basic things that, are hope our goal is to utilize that and help them get set up so that they can look and learn about, IDAs, because that's one of the things that we talk about.
Yeah.
These programs are here and available, and it's just so important. And I think if more people, I used to sit on the North Central Washington Business Loan Fund. We had a non-traditional lending program, and we funded a lot of, I can still in this region today go into a lot of these different organizations and businesses that we helped fund, and our executive director retired and we couldn't get anybody, and actually Craft 3 absorbed our loans, and we partnered with them. And that's, when the relationship with Craft 3 really came into place with Okanagan County. But I was on the credit committee, and then I also was on the board, and we got to see all of these projects. And again, so many of them are still there today, and it was a risk that we took, and we had faith in the businesses, and it was really exciting to see them be successful. And so it's important. Craft 3 is one CDFI that we have access to. Here in our area, we have the Northwest Native Development Fund, which is over in Nispelem, and they do a lot of work in the tribal communities, but they also provide services to non-tribal members. They do some of those lower end, loans that could be under $50,000, but they can also go up. I think their max might be 250,000. I'm not positive on that, so don't quote me. I might be wrong. But we have, businesses have, ways to go out and access different resources. And the community development financial institutions, to me, are legitimate. I have people call me up and say, hey, I just got this thing on the internet, or it popped up, and I went ahead and I applied, and they pre-approved me for $50,000. And, all I got to do is sign the paper. And I did. And now, 2 months later, I didn't know that it was a variable interest rate, and it said starting off at 5%, and now I'm paying 25% interest. And it's, there is a penalty for early payoff. I can't get out of this loan. And so it's really important to us to really let people who are out here in Okanagan County and in our region, or whoever's on our Facebook page watching this, to really trying to find resources that are legitimate, that they don't find themselves in these predatory lending situations where, they end up paying that 25% interest for 10 years or 20 years, and they can't get out of it. So going to the right places and asking the right questions.
Yeah. You touched on a couple really important points. When you're talking about personal credit, I've had countless people that I've talked to in the last 3 years working at Craft 3 who have had great businesses, great business models. But when it comes down to needing additional capital, when their personal credit has been in the back seat because they've been, busy running a small business, that could be the detriment to everything. To bank lending, to CDFI lending. So understanding and having wraps on your own credit and financial situation is key to success in applying for any debt. When you're talking about predatory debt, that could be a reason that your debt and your credit is bad. Predatory debt is made and modeled to keep you in the cycle of borrowing money. You want to borrow money when you need it. You don't want to have to borrow money, is kind of the way I think about it. So when you borrow from various, if it's really easy and really quick, typically there's something else wrong and you're going to want to understand it. Earlier, I kind of touched on making sure people understood how much it costs to borrow here at Craft 3. That should be a question that every business owner asks their lender is how much is this loan going to cost me? And if they don't have a direct answer, that's a real big red flag because, whether it's origination costs, whether it's closing costs, whether it's the total amount of interest over time, all those things are readily available for us as lenders to explain to borrowers. But oftentimes, if you're paid by the loan, you don't want to share those numbers because it becomes scary that, how much interest am I paying on this money? So then from there we can support them with, but if you paid an extra $300 a month, this is how much you would save. If you paid this off in 2 years, this is how much in total interest you'd be paying. And those conversations can only come when the lender is looking out for the borrower. And not every bank is looking out for the borrower, but also not every bank is only looking out for themselves. So if you have trusted advisors, that's a big way that you're able to support yourself as a small business owner in success.
Well, I think we're now to our final question. This 15 minutes turned into 40 all of a sudden. And I think we were just having a really good discussion. And I think hopefully this information will help the entrepreneurs that we work with and that are in our area to make good decisions when they're looking at loans, small business loans, and that they now understand Craft 3 a little bit better and know that you guys are here and available. So my final question, Steven, can you share with us, what are some of the strategies that small businesses should use to ensure that they have a successful loan application, whether it's with you or with anybody else?
Yeah, that a successful loan application is important, but I also think, having a successful business model starts that.
Yes.
Because, if you can get approved for loans in many places, whether your credit's good, bad, or indifferent, because of the rates people are going to be charging and what they want out of you as a borrower. For me, I think the number one piece of advice I give to small businesses starting or existing is to have a solid team. So if you're starting off utilizing the SBDC, utilizing SCORE for the business planning, having a separate set of eyes kind of question what you're doing and maybe about things that you may be blind to because you're so excited about what you're doing. Having a coach or a trusted advisor criticize specific parts of your business plan actually will help you succeed in the long run. Understanding financials. So if you don't necessarily understand it, at least understanding who you can ask.
Right.
Because every lender is going to ask for financials. Every lender is going to want to understand, what your profit and losses look like year over year versus your balance sheet year over year. Having those resources in Okanagan County as well, because there's not as many in-person resources, utilizing the Economic Alliance is going to be really important, but also seeing what resources you have in the region digitally. There are classes that you can take with various courses, with various CDFIs for specific things like marketing, like business planning, like understanding basic cash flows. Like there are classes that you can take virtually since you're likely in an area that is not heavily populated or has a lot of in-person opportunities. Doing that work prior, being ready for the loan. Craft 3 actually has a loan readiness guide that can walk folks through, what you need to know, words, definitions, processes. And a big part of that, there's a diagram in there that talks about the path of a business, and it's not a straight line across it. It goes forward and it pops back, and it goes forward 2 steps and it pops back 1 step. And that's something that you have to understand that there are going to be challenges. So having the people backing you, the advisors, the support, the community, whoever that might be, will help you be successful in order to have a successful loan application, which hopefully is just a small part of your business.
Right. Oh, that's great. That's really good information. Um, and so, I wanted to thank you very much. I know you're super busy. So thank you for taking the time to be a part of our Business 101 interview with the experts and for taking the time out of your busy day to share this information with our small business community. Is there anything else that you would like to share with our audience before we are done today?
No, I mean, I feel like we've asked great questions. We've answered a ton. Just recognizing that small businesses are like the heart of community and one of the biggest risks people can take. And if you're already watching this video and are a part of the Economic Alliance or understanding who they are, like you're on the right track. And we're happy to, Craft 3, we are happy to be an additional resource. Where available. You can find me on the website and email me directly if you have questions. Happy to support directly, or one of my colleagues can also. But we're here to partner. We're here to support the community and hopefully help everybody succeed together.
Thank you, Stephen. And what was the website?
It's craft3, CRAFT, the number 3.org. And there's tons of resources there for commercial lending, consumer lending, heartfelt stories of wins that we've had, a couple pictures of me. I mean, it's got everything you need.
Great. So if anybody wants to contact Stephen directly, you can go to craft3.org. Again, thank you everybody for joining us today. Don't forget to tune into our Facebook page where we are rolling out important resources and programs for small businesses on a daily basis. We have our Quick Bite series. We have our YouTube channel that has all of our library of past trainings that are available on demand. As we understand that when you're in business, the majority of the time you're in that business operating and running it on a daily basis. So you might not have time to join us in these live sessions or to come to the office to attend a webinar. So we're trying to build that library up so you can go and access that on demand. And the YouTube is Okanagan County Economic Alliance. So just search for us and you will find us there. Thank you all very much for joining us today. I appreciate it. And we hope that you learned something today. Thank you. Thank you, Stephen.
Thank you.